And so on to the next one. So this problem says, when inflation is blank, the Fed aims to slow the economy. So the Fed is the Federal Reserve, and it's the kind of body that regulates the money supply and monetary policy. And so if the Fed is aiming to slow the economy, what that really refers to is contractionary policy, contractionary monetary policy, right? And so we would attempt contractionary monetary policy if we had a expansionary gap, right? And so let's take a look at the dynamic ADAS model. And so this is where we really see contractionary and expansionary policy coming into play. So we have our long-term aggregate demand, long-term aggregate supply, and then we have our short-term aggregate supply. Oh, sorry, this is aggregate demand, and then this is short-run aggregate supply. And so in this scenario, we have the short-run GDP is greater than long-run potential GDP. So we have this. This is our expansionary gap, right? And so this is a period of time in which the Fed would hope to engage in contractionary monetary policy in order to reduce the rate of growth of the economy. And so the question asks, however, when inflation is basically high or low, right? And so we have to look at price levels here, and we can see that at the long run, we would see that when the inflation rate is high, that's when we would really see a expansionary gap because with a long run equilibrium, we might see something like this, where you have all three lines intersecting at the same point. However, and that will give us a price of P star. However, with high aggregate demand in the economy growing too fast, we see we are actually at P1, which has, oh, sorry, this is drawn at the wrong level. Let's try that one more time. P1. P1 is where we are right now, and that we can see that the price levels are higher than they would be at long-run equilibrium, and so that would define what inflation is, which is higher prices overall. And so the Federal Reserve is going to want to slow down the economy when we have a the Federal Reserve is going to want to slow down the economy when we have an expansionary gap, and that is defined by high inflation due to larger than long-runly possible aggregate demand. And so the Federal Reserve is going to aim to slow down the economy in that scenario when inflation is high. So let's take a look at the explanation given by the previous tutor. The previous tutor says, the Federal Reserve aims to slow down the economy by adopting a contractionary monetary policy when the inflation rate is high. So that's exactly what we've depicted on the graph. The increase in aggregate demand leads to an increase in prices, which reduces the purchasing power of the currency. When the inflation rate becomes aggressive, the Federal Reserve attempts to decrease the money supply, which reduces the spending capacity of the consumers and brings the aggregate demand down that moderates the inflation rate. It decreases the money supply either by increasing the interest rate or selling government securities and bonds under open market operations. So I think the previous tutor did a good job covering the essentials for what we see on the graph, and also explained a little bit about the entire process by which the Fed would go about trying to slow down the economy or go about engaging in contractionary monetary policy. So that's really good. We're going to clarify that this can be seen on the aggregate demand supply graph. This is observed on the dynamic ADAS model with the expansionary gap scenario. Otherwise, great answer, right? So otherwise, we have no problem with that. I just felt like it was important to note that if in terms of looking at this from a graphical standpoint, we want to look at this model over here. Okay, let's take a look at the next question.